Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 333rd VideoCast podcast for the week ending March 5th, 2026. We got a lot of great stuff to cover today, but as always, family first. This is Mimi here. She had her Olympic development trials. So Mimi crushed it this weekend at Olympic Development Regional Tournament. She made the A team and will play in the national tournament in 3 weeks. Annabelle, on the other hand, swam her first Speedo sectional swim meet. She was the youngest at the meet and had so much fun getting her butt kicked by 18-year-olds. So that was the story of the weekend. There's Mimi. I got to play Trump LA in Palos Verdes last Friday with my buddy Mike Bennett. You may recognize from the cover of the famous book Stack and Tilt Method. He invented it with his buddy Andy. Thanks to Paul K, John M as well. We had a great time. Paul was an awesome host. And then we had, there's Annabelle. There is, this is the guys. We got the chance to play Rolling Hills up also in Palos Verdes. This is a hidden gem of a course. I want to thank David M, Chris F, and John N. You know who you are. Absolutely incredible time. Note that we all had our putters on the par 3. That was a good hole. Here's Mimi trying the Michelin star aspirational Papa John's new pan pizza. Papa John's is trying, one of our holdings, is trying for a Michelin star on their brand new pan pizza. I would strongly suggest you get it with pepperoni. I think they have a shot. I really liked it. The Parmesan crust is kind of crunchy and cheesy. It's light. It's good. The marinara sauce is phenomenal. Check it out at Papa John's. Mimi was loving that. That's me at Rolling Hills. Swing looking pretty good after a round with Mike. Here's some beautiful views at Trump LA. Unbelievable. You know, if you ask me if you want to play Torrey Pines or Trump LA, Trump LA has views on every single hole. Want to congratulate Claire Tran for becoming the valedictorian of Westminster High School. There is Statman Cork Snyder, the AP Stats teacher who had me to speak to the whole student body last year, had an incredible time. And out of that, Claire has become an incredible mentor to my daughters, teaching them advanced math, the same advanced math that got her into Harvard. So there you go. Congratulations, small world. And then we'll just do 2 quick goals from Mimi's Olympic development this weekend and move on to data. Here is the first one. Skip shot. Watch this quick. Boom. Skip shot angle. And here is this one. Here's boom, one-timer skip shot. Absolutely incredible. We have a new website for Great Hill Capital. Doesn't really change anything we do here at hedgefundtips.com, but this is for our investors, people that want to invest with us. And kudos to Jeff and the team, international team, who got this together in record time this week. Really did a great job with greathillcapital.com. Moving along, we've got our media. Want to thank Justin Oliver, Brian Sazi, Brooke De Palma, Inez Ferre for having me on Yahoo Finance. This was a really important interview. It lasted the full half hour, but we cut out all the non-important parts. Talking about the overview of Iran, talking about 5 or 6 holdings, and a lot of great stuff. So we're going to listen in here.
Global conflict that questions the U.S. dollar doesn't send Bitcoin ripping. What will? I don't know. I don't have that answer. But maybe the opening bid roundtable friends do. Thomas Hayes, Great Hill Capital Chairman and Managing Member, alongside Yahoo Finance Senior Reporters Brooke Palma and Inez Ferre. Tom, coming out for you, we're seeing the markets. They had a rally yesterday. That was good to see. Nobody likes to see the Dow close down over thousands of points. Seeing some strength out of the block here today. Is the bottom line this, that rallies against this backdrop should be sold?
No. I think this morning we got some important news from the New York Times for the first time in a while, which is that the Iranians reached out through the CIA. They're ready to talk. They're ready to come to take steps to end the war. That's a big deal. The whole name of the game with the markets is, does oil pass through the Straits of Hormuz? And President Trump said we're going to ensure it through the IDFC, and we're going to have U.S. Navy escorts. We shall see. People will be watching those ship radars and see if they get through. If they don't get through, then you have problems like you saw yesterday, which is inflation, which means no Fed cuts, which means risk to private credit, which means yields blowing out. If they do pass through, oil will come down pretty quickly. The inflation fears will subside. The expectations of a Fed cut from Warsh will go back up, or 2 cuts or 3 cuts, which is the name of the game for the economy and for private credit to extend and pretend and push the problems to another day.
Tom, why have we seen this resilience in the stock market in its simplest terms?
Because the economy's strong. I mean, look at earnings, 75% reported, 14.2% earnings growth. That's 5 points above expectations. Not only was it better in the rearview mirror, it's better prospectively. Estimates are actually going up. $363 on the S&P for 2027, $313 for 2026. Even if you look at the PMIs yesterday, the global PMI 51.6 versus 51.2, ISM manufacturing 52.4 versus 51.7 expectations. That's the name of the game. You see ISM going up, the economy is going to follow it. So this is a short-term thing. I think it was timed pretty well. I think if they can, I think you'll have some fits and starts over the coming weeks, but per that New York Times leak, it seems like things are moving in the right direction. And it seems like it was kind of a checkmate. I mean, you take out their Navy, how are they going to block the Strait of Hormuz? We don't know exactly what the leadership looks like in Iran. And yeah, there's worries it could be worse than it was before. But on balance, if that oil flows, they'll figure out the rest. I'm
far from a ship captain, but Tom, I think I can put 2 and 2 together. You're making a lot of sense to me right now. Inez, over to you. I appreciate Tom's optimism here. I like it. We need it after a challenging week so far. But I will counter with this, Inez. We are already starting to see gas prices throughout this country starting to rise. And I put out a video this morning on my X account wearing a black hoodie, just flat out slinging it that by the end of this week, gas prices are likely to be higher than they are right now. What is the risk to consumers
around them?
Tom, come on, look, if we get gas prices over $4 a gallon, that's going to be a shock to the consumer, and they're not out there spending. There goes the economy in the first quarter and maybe the second quarter.
Listen, Inez was talking about 10 cents and 20 cents. We're still not anywhere near the average price of oil when Biden was president. So, let's cool our jets. Here's what we know about the stock market, though. Buy the bombs is a real thing. Sell the rumor, buy the news. What we have since World War II is following a U.S. overseas military strike. 12 months later, the S&P is up on average 12.9%. Could this time be different? Sure, it could always be different. Could oil prices go up to, look, I live in California. I just filled up my tank. It was over $5 last night. That's because it's California. That's because we have ridiculous regulations. The rest
Tom,
of the
that's
country
dreadful, dude. I mean, you got to just turn on your car. Start walking to work, man. You could do these hits from your home or something. Come on, man. I feel bad for you. It's horrible.
I'll tell you, it's sunshine all day. It's
not. It's over $5. What are you driving, Tom? What's your car? What do you got?
It's a nice one. Let's just put it that way. We'll take it offline. But look, to Brooke and Inez's point, certainly that would have a huge impact on the consumer and offset maybe some of the beneficial increased tax refunds. But that has to be prolonged. It has to be a durable increase in prices, and it just doesn't look that way. It seems like President Trump is focused on the most important aspect of this, which is getting the ships through. And it might be fits and starts, and it might be more problematic than expected. But I think sooner or later, and probably sooner, those ships are going to get through one way or another.
Tom, like always, you do send over some stock ideas. I hope I got this one right from the team, and it's on me if I didn't get it right. It's AutoZone, and as soon as I heard that mention, Advanced Auto Parts, I should say. Thank you, team in the back.
Yes.
I appreciate it. I want to make sure I have it right. And I immediately thought Tom might be laying out recession plays. I own my car longer. I might have to fix my own muffler. I'm not trading my car in off lease. I might just buy the damn thing and own it for 15 years.
Yeah, well, look, on average, the American owns their car for 14 years right now, which is a record high.
Wow, really?
So there is some truth to that. But Turnaround Tom loves turnarounds, and this stock has been absolutely decimated, which we love because Shane O'Kelly came in. He ran HD Supply, which was a $7 billion business for Home Depot. He shut down all the unprofitable stores. That heavy lift is done. He's cut a ton of costs. He's going to increase margins back to 5-year-ago levels. He's already started opening new stores, so they're going to be running at about 100 per year. And basically what he did was he took all of the areas that were not where Advanced Auto Parts was not number 1 and number 2, and basically shut down the unprofitable stores. And he's consolidating the hub and spoke model so it can be run like a proper business, like O'Reilly is run, and follow that model to get back to profitability, high margins. This was a $150 stock. If he gets his margins back up to 7-8% like he talked about by 2028, you could be back up at 130, 140, 150 over the next 3 to 5 years. So with the downside protected, he's deleveraged the balance sheet by selling off the Canada business, and the return to growth, the comp store sales now rising for the first time in years. We like this story. And to your point, with the average car on the road, 14 years, people have to replace it. You can't really ship batteries through Amazon. So we like the story.
Inez, your car's not 14 years old, right? It wouldn't even have Apple CarPlay. I mean, how can you even drive without Apple CarPlay?
No, mine is a used Kia. I love it. It is amazing. It's a hybrid, and it's easy on the gas. So,
but Tom, no, that's good. But Tom brings up a good point. It is okay, and I think it's a good reminder to investors. You could still go out there and pick stocks. If there's a good story, if the valuation's appropriate, you could go out there and still do that. I understand the backdrop is tough. No one likes to see the market swinging like they are, or wake up one day you see the Dow down over 1,000 points. It is still okay to go out there and do your homework on stocks.
For sure.
Amen.
I mean,
Tom, real quick back to you on two topics. One, is this a good backdrop to look for value names? And then number two, I know we haven't talked a lot, you and I, about crypto. Crypto is bouncing a little bit. Does that represent any sort of a term of, I guess, value play for you, given all the geopolitical instability out there?
I wouldn't buy crypto with your money, Brian. But leaving that aside, I'm a stock picker because.
Well, I need that luxury car, Tom. Whatever you're driving, you won't tell me right now, but I need to buy one.
I got a few of them. We'll talk offline. But let me tell you something. You can get the car that you want through buying high quality businesses when they're on sale. Now's the time to be in dividend players, because once this blows over, rates are going down. He'll offset that by tightening liquidity from shrinking the balance sheet. That's with Warsh coming into play in May. And you want to be in your Hormels, you want your Skippy, your Spam, and all Planters peanuts and all the great GLP-1 protein-friendly products that Hormel makes, not only because you can lock in a 4.75% dividend yield, but because they've raised that dividend yield every single year for over 60 consecutive years. That's what we call a dividend aristocrat. So Hormel Foods, you got to love that Spam. X-Ray, Dentsply Sirona. Here's another one, the leader in dental supplies and dental technologies. This stock has also been taken out to the woodshed. Turnaround Tom loves a great story with a new CEO. This has a 5% dividend yield, free cash flow positive, very cyclical business. Comps are turning up. This CEO had a 4-bagger while he was CFO, CCO, and CEO of Globus Medical. He's applying the same sound principles to his operations at Dentsply Sirona, ticker X-Ray. And then finally, you can't go wrong with Pfizer if you want to get paid every single quarter with a 6.5% dividend yield, a very attractive cancer franchise, and free option on the Metsera oral drug for losing weight.
Brooke, you cover a lot of these food companies. I'm glad Tom mentioned Hormel. I could see the correlation. You need dental supplies after eating all of that Spam, I guess, or whatever. Those peanuts that they put out, what is Planters? They bought that Planters business 5 years ago. Brooke, what? Tom, I'm not dumb enough to think you're going to come up here and say, hey, we're headed towards a bear market, or we're even going to get a correction. So let me come at you from this direction. How would you know the market is getting increasingly worried? It shrugged off what was going on yesterday, out of the block today, a little bit of a stabilization. Like, what would you see in the market start to happen that would say, you know what, maybe we are headed towards that correction? What has to happen?
Credit spreads would start to blow out. So, look, midterm election years are supposed to suck, Brian. And let me tell you what I mean by that in terms of data. On average, the NASDAQ is down 0.5% in midterm election years. Where you want to be hidden in midterm election years is healthcare, which is up 9% on average. On average, in a midterm election year, you have an 18.3% drawdown. I don't think we're going to get that. I think 10%, yes. Sometime mid-year, probably before the election, maybe up to 15%, but not more than that. 20% corrections happen on average about every 3.5 years. If you look back 100 years, we've pulled forward. We've had 3 of them in the last 6 years. So I think it's going to be more subdued. I think the tax refunds are going to be okay. I think software, to Inez and Brooks' point, is dramatically oversold. And here's the thing. I do think we are going to get a violent counter-trend bounce in software and probably Mag 7, despite CapEx as a percentage of operating cash flow being 92% and buybacks being the lowest level in years. And I do think that that software violent bounce in the next couple of months is going to be sold by institutions who are trapped and want to get out. So I think that'll be a head fake. I think we got some weakness later in the year. I think stay in defensives, follow the broadening trend, small over large, international over US, value versus growth. I think that'll serve you well, and get some dividend payers ahead of Warsh, which tend to be value tilted. And I think you'll be able to navigate the storm just fine. And then post-election, the market tends to recover into year end. But we are going to get some volatility this year. The stock market returns are going to be subdued. But I do think GDP and nominal GDP is going to be better than most people are looking for at the moment.
Tom, real quick, like 20 seconds, fast follow. Does $100 a barrel oil equal stock market correction?
Yes. Mm-hmm. We're not getting it, though.
Okay, we'll leave it there. Inez, thanks for bringing up the term summer blend. Appreciate you guys. Good work as always.
Now you're in for a treat. I had the incredible privilege to speak to a bunch of peers, successful entrepreneurs today about our investing framework, and in 12 minutes laid it out A to Z. And these were super highly successful people. You're going to get a tremendous amount of value. Let's listen in here. Okay, well, thank you so much for having me, Deborah. Sure. We're going to bring up the slideshow here. And by the way, I'm going to go through this very quickly. So you should know that you can get the slides at the end of the presentation. I think Deborah will make those available for you. Happy to do it. The purpose of this, I'm going to go through our investing framework so that you may be able to apply some of these principles in your own investing. What made most of the people successful on this call as entrepreneurs is massive action equals massive results. I'm going to share with you a framework where you can do less and get more. I like to say massive inaction when it comes to investing equals massive results. So we're going to turn dislocation into opportunities. A little background, our investing framework, and then some case studies, some past case studies and a current case study so you can see how it works in real life. By way of background, Great Hill Capital is the firm. Before that, I was with Cornwall Capital Management. You may remember them from the movie The Big Short. I worked for Brad Pitt, much less handsome in person, but probably 10 times as smart, Ben Hockett. Before that, I was with a firm. The principal was friends with Warren Buffett for over 30 years. So we went to Omaha every year, and I cut my teeth in the value investing mafia in New York with hedge fund dinners with Lee Cooperman and Mario Gabelli and that type of stuff. Here's some media stuff. Most of you have seen that. But here is the core philosophy. And this is from the master himself, Warren Buffett. And this is the philosophy of our investing framework. And that is, great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. In efficient markets, unless you're buying during periods of dramatic dislocation and doing in a concentrated way, it becomes pretty difficult to outperform over time. So we profit from buying on weakness and selling on strength, driven by deep research and the belief that the greater the dislocation actually reduces risk. Where others see volatility as danger, we see opportunity. So in that context, here's your edge. If you're buying companies that are down in price, but not fundamentals by 50%, 60%, 70%, 80%, the edge that you're going to have is your time horizon. And this is from the great Ben Graham, and we've modified it a little bit. Ben Graham said, in the short term, the market is a voting machine. We added based on emotion, whereas in the long term, it's a weighing machine based on fundamentals. What does that mean? The price of a security, the price of a business quoted in public markets, will eventually, over time, you can't determine over what time, but guaranteed over time, will catch up or catch down to the underlying fundamentals. And that's the edge. Most people do not have the patience for the price to catch up or to catch down from the underlying fundamentals. And we're going to show you a little bit about how we look under the hood. And then the temperament is also required. They call me the Iceman, to ignore the short-term noise and the short-term headlines long enough for that price to let the weighing machine kick in over time, to let that price catch back up to the underlying fundamentals. We buy stocks sometimes that are down 50, 60, 70%, durable cash flowing businesses that have been around for decades. And maybe the revenues are flat, maybe the cash flow is only up 1%, but they're not down anywhere commensurate with the price. And that is our edge, and that's the opportunity. So time horizon, temperament. Now, everyone on this call is very smart. Isaac Newton was very smart. I think you all agree. But Isaac Newton got caught chasing shiny objects in the South Sea Company bubble. He bought the stock at 200. He sold out at a double, close to 400. He was happy, except at 500, his friends were still getting rich and he got jealous. So by $700, he couldn't stand it anymore. He bought it close to the top. It went to almost 1,000. He wound up buying the dip and chased it all the way back down to 200. He exited broke, one of the smartest people in the world. And I see that with successful entrepreneurs. They think if they work harder and take more action, they'll get better results, because that's what made them centimillionaires or billionaires in business. And it's the exact opposite skill set in investing. So some people develop that skill set over a few years and retrain themselves. Other people just outsource it and hire the best, like they did in their core business. Here are our two core filters. You may want to jot this down. The first is the conviction test. So what I look at in a public security is, if JP Morgan debt financed me to buy the entire company with one catch, they said, you have to be 100% of the equity slug with 100% of your net worth. So the equity slug would be small. So if it works, we'd make many multi-bags. Even if the stock just, if the company just doubled, I'd make 10x. If it doesn't work, I would get zero and JP Morgan gets the company, which means I'd be wiped out and I'd be applying for a job as a greeter at Walmart. So if I won't do that deal, we won't even buy one share. It's like the Warren Buffett punch card method. Most people would be better off if they got a punch card after college and said, you can only make 20 investments in your lifetime. And the way Warren Buffett said is, you probably won't make it past 7. You'll be so wealthy. When you have that type of intentionality, resist the urge to dabble, is what Warren Buffett said. You feel like something's in the headline, you have to get a little piece of it, you have to be involved. And that type of activity leads to poor outcomes over time. The second is the dislocation test. Remember, if you're not taking advantage of the inefficiencies of dislocation, it's very hard to outperform. So how do we measure that? Well, if we were to go into the board of directors and offer to buy the entire company at the price that it was currently quoted in the market, would they call the security guards to have us escorted out of the building because they found us exceptionally insulting? And if the answer is no, they would not call the security guards. They would actually entertain the offer we will not do the deal. We want the price in the market to be so insulting relative to intrinsic value that no rational board would accept it. And that's why we prefer public markets to private markets, because the pricing that the irrational, as Ben Graham would say, manic depressive stock market will serve up from time to time would never, ever be found in the private markets with no rational actor doing that. In the public markets, there are benefits of forced selling, structural selling, institutional active managers not wanting to have stocks that are down 10% at the end of the quarter on their books. So they're all forced sellers, and we benefit from that by being buyers into the distress. Okay, so if you're buying companies down a lot, you better have a filter. Solvency, they've got to have the strong balance sheet to live another day. Management, did the manager who set the fire, are you hiring him to put it out, or are they getting a new manager that's going to improve it? Moat, is the moat temporarily impaired or permanently impaired? If a stock's down a lot, the market is telling you maybe there's a permanent impairment. It's your job to do the work and discern. If they've been like VF Corp, we're going to talk about, they've been buying and selling consumer brands for 125 years. My bet is the moat is not permanently impaired. They know what they're doing over time. And then what's the catalyst? You don't want to just buy cheap and be stuck in a value trap. You got to have a catalyst for a turnaround, which is why they call me Turnaround Tom. So here are some examples we've done. We like to buy the highest quality assets in the most dislocated sectors in the stock market. So during COVID, oil went negative for the first time. Were we buying Carrizo Oil and Gas in West Texas? No, we were buying ExxonMobil at $30 a share. That was an easy double. Wells Fargo, banks, people were worried during COVID. We weren't buying some regional local bank. 2,000 of them went out of business. We bought Wells Fargo, which was trading at a 50% discount to tangible book. Only did that one other time in history in the early 90s during the real estate crisis in Southern California. That was an easy double. Then 2021, there wasn't much dislocation. Everyone was fat and happy and all the checks were going from the government. So you had to wait till 2022 when that froth came out of the market and no one wanted tech in the fall of tech. Credit markets froze up. You couldn't give away Amazon.com at 50% off. That's when we were buyers. Google, we weren't buyers at 2021 when everyone wanted tech. We were buyers when no one wanted it. And that's when you want to look on what's the highest quality asset in the most hated sector. Same with Google in late 2022. Cooper Standard was a turnaround situation. This was all about solvency risk. Stock was down from $146 down to $5. We put a huge position on. The market was betting they couldn't get refinanced. We did the solvency analysis. They got refinanced. The stock is now 40. We still own a ton of stock, and it's going higher over time. Alibaba, think 2-3 years ago. China was uninvestable, the most hated sector in the world. We bought the highest quality asset, which was Alibaba. Our blended basis was just over 82. The stock doubled. Our long-dated call spreads were up 7x. We took those off. We still own the stock, and we think that's going to play out well over time. Rolls-Royce was a play on engine servicing hours. You couldn't give this away in 2022. We were so smart. We bought it at $150. We sold it at $7. It's now at $18. So we weren't that brilliant, but if you can't take a joke. 2023, a lot of real estate people on the call. What couldn't you give away 2.5 years ago? No one would buy an office building. So we didn't buy B and C class stuff. We bought the Vornado at $13, $14, the highest quality buildings in the greatest city in the world in New York City. And that one recovered much faster than we expected. We thought that would take 5 years. Intel, when it was $19, we went on Fox Business and we said, listen, Stuart, we were on Varney. We said, if they liquidate the whole damn company tomorrow, we're getting $22. That's book value. The legacy business is worth $45. And if Lip-Bu-Tan can actually deliver on advanced chips, it could be 100 plus. We took off half the position in the low 50s, and we're holding the other half for Lip-Bu-Tan to deliver. Estee Lauder was just a play on China being out of favor. China is now recovering. So is the stock. Albemarle last year was materials. People were down on EVs. You couldn't give away lithium. Lithium is a very cyclical business. We like that in turnarounds. Bought at 59, sold at 164. Damien makes fun of me because now it's at 190 or something. But if you can't take a joke, that's the way it works. One that we're currently in, and then we'll wrap it up, is VF Corp. They've been buying and selling consumer brands since 1899. First thing was solvency analysis. You may know the North Face is hitting on all cylinders. Timberland, Ultra, if you're runners. If you ever went to school, JanSport, Eastpak. The one that's been the weight on it is Vans, which is now starting to turn around. They sold Supreme and they sold Dickies. They raised $2 billion of cash, deleveraged the balance sheet, so solvency risk is off the table. Our basis is $14.45, so you're able to be involved at a similar price. This is all opinion, not advice. Talk to your financial advisor before you do anything. But now the second thing is management. They got in a new CEO named Bracken Darrell. Bracken Darrell is a turnaround specialist. He got into Logitech, that makes the webcams and the mice, in 2023 when the stock was down 84%. If you invested $1 million when he came in to turn around the company, by 2021, you had $26 million. No, he did not cure cancer. He did not predict the winner in AI. He sold commoditized mice and webcams and was still able to create that value for shareholders. So that's basically my presentation, and I'll be here at the end of the presentation to answer any questions from my side. Quotes of the week from Peter Lynch. You get recessions, you have stock market declines. If you don't understand that's going to happen, you're not ready. You won't do well in the markets. This is some short-term volatility with Iran. We are not going to have a recession this year, and I discussed in Yahoo why as well. We will have a recession. They are inevitable. It's just not right now. Here's from Ben Graham. The intelligent investor is a realist who sells to the optimists and buys from the pessimists. That's what we do every single week here at Hedge Fund Tips with Tom Hayes. And many of you have benefited by listening in, for some of you for weeks, some of you for months, and some of you for many years. And for that, we are grateful. And we know you are grateful too, because all we ask is that you share it with one person you care about each week that could benefit from this information. And many of you are. And some of you even sent in a bunch of photos using the merch. Many of you wear the hats and the shirts. People ask you about it. You share the podcast. We got new ones in from Henry, Ryan, Mary, and Jack R. What a beautiful picture. And then we got more here from Matthew Allen from South Africa wearing his golf polo, and so many more. We talked about Adam last week. So go ahead and send in your pictures wearing the merch. You can find that at hedgefundtips.com. Click on number one hedge fund podcast and share the word so we can keep doing this for you for a very long time to come. All right, so here's PayPal. Opinion follows trends. RBC upgrading with a price target of 59, talking about the scenarios playing out moving forward. The scenarios we've covered ad infinitum: buy back stock, execute, double over the next 3 to 5 years, and meant much more as they get the advertising business cranking. And a lot more, which we went into last week. Let's go into some of the Slumer charts. You can see here, crude shooting up to this resistance range. We'll see if we get some developments in the war. This backs off. The inflation threat backs off. The cut probabilities go up. The private credit fears go down. We'll see if it's at this level or the next level, but we do know this will get dialed down. We just don't know when. And we think it will be in relatively short order, as long as those ships start passing through the Straits of Hormuz, accompanied or unaccompanied. This will roll over. 10-year yield back up to resistance here. It got down below 4%, probably stalls out around 416, 420 before continuing the downtrend starting over a year ago when it was at 480 and everyone said it was going over 5, and we said, nope, it's going below 4. Well, it finally happened. It happened in 3 months and then it backed off, but the downtrend is intact. yields lower over time. Here's the S&P. Got down and down to 67.21. Retested that range today on the Dow and the S&P 500. Now we'll see if it holds. A Friday going into a long weekend, probably not the time we're going to find the bottom, but Monday or Tuesday next week would be potentially the time to be looking for something like that. MSCI World up against resistance. It looks like it wants to probably back off for a little bit before taking the next leg higher. Technology, will it find support here? I think we're going to see a violent counter trend rally in software that will be sold after a couple of months into the fall. So rip higher probably includes tech and all the stuff that's gotten shredded. By the way, I heard a stat yesterday. You won't believe this. 3%, the S&P was down 3% on the year. The average tech stock in the NASDAQ was down 26%, which is mind-boggling because that's all the retail people who have chased the shiny objects, high multiple stuff that have gotten slaughtered. So while on balance, it's, this is a garden variety short-term volatility, a lot of people have been really pounded, even though the indices are down 3%. Some of these software and tech names that were super crowded last year that we urged you to avoid are down, 40, 50, 60, 70%. So stay away from the shiny objects, ladies and gentlemen. And if you've been listening for a long time, you did that in spades, and we're super happy for you. I talked about buy the bombs. Here are the stats of overseas military strikes since World War II. On average, 12 months later, up 12.93%. 6 months later, up 8.01%. 1 month later, up 1.09. So sell the rumor, buy the news. Dentsply Sirona table is cleared. This is from Stifel. Turnaround in sight. They took their price target up to 14. And that's that. And then most widely held names should be avoided. Post-eco inflection points when PMIs recover. So this talks about the ISM manufacturing index, propels a broader earnings backdrop, which it makes investors reconsider many stocks they've avoided or been underweighting for 3 years. The most institutionally owned stocks tend to lag when macro begins to broaden. These are the early stages. That's why I think this is going to be a counter trend bounce in software and tech that's just starting and will be violent to the upside and catch a lot of people chasing it again, and that will be a trap. Institutions are going to use it to get out. Why? Because software is going to re-rate and pricing power is now eroded with the new AI tools, but that won't be felt like that in the next 2 months as it has in the past 2 months, because people will be chasing it again near the top before it rolls over materially into the elections. New World Order equals New World Bull. You can see international ex-US as a percentage of MSCI All Country World Index. It's starting to recover just like it did in the early 2000s. That's been a core analog we've been discussing for many, many months on Hedge Fund Tips with Tom Hayes. It's now playing out in spades. Long-run earnings growth for MSCI emerging markets setting up for one of the strongest earnings cycle since the mid-2000s. This has been our analog. This is now playing out. You guys were paying attention while most people were asleep at the wheel, and it is early days. Inflows into global stocks annualizing at a $1.1 trillion rate. You couldn't give away an international stock last year. Now everyone is crowding in, and it's early days. Bull and bear indicator got a little frothy. That's why the shiny objects got the stuffing knocked out of them in the last 2 months. And now we will see a counter trend bounce for all the people that bought at the top last year, now are selling in the hole. There will be a violent counter trend rally. They will buy again close to the top right before a big weakness into the fall in those type of stocks. Equity trading volumes have doubled since 2023. CEO confidence surged in Q1 2026 to the highest level since Q1 2025. Forward earnings expectations still rising. Covered that on Yahoo. Percentage of countries in a bull market is now back up to 75%. 30-year fixed mortgage rate finally did it. We've been saying it would happen. Last week it happened for 5 seconds. The 30-year fixed mortgage dropped below 6% for the first time since September 2022. That will reoccur in coming months. We'll get back down into the 5s and then trend lower, which helps our housing plays of Stanley Black & Decker, Generac, QXO, etc. National Association of Active Investment Managers getting washed out a little bit here. We'll see how low that has to go to fully wash out. Even if compute equals revenues, it doesn't equal cash flows. Hyperscalers' estimated free cash flow for current and following calendar years is absolutely plummeting. That's why I think you're going to get a hard counter trend rally higher from the lows, whether they're put in the next couple of days or the next couple of weeks. It will be violent to the upside. Everyone will chase back into tech and software, and they will get rolled in the Q2, Q3 periods after selling the bottom and rebuying the top. More churning at the top while NYSE advanced decline at new high. I think the implication here is that the probabilities favor a breakout in March and April back above 7,100 to new highs, sucking everyone in before we get some real weakness into the fall and then resolution higher after the election. Credit default rates are rising to 5.8%. That's what has people a little bit nervous. As rates come down, once these war jitters are behind us, the rate cut odds will go back up, and a lot of this private credit fear in the short term, which will be a major problem down the road, will get alleviated as people refinance on lower rates. This is the most important chart that we're watching, which is consumer sentiment. This is at the lowest level since COVID, and prior to that, the great financial crisis. As this starts to turn up, you are going to see a rip your face off rally in consumer discretionary, in names like PayPal that benefits from a strong consumer, restaurants, etc. All you have to do is look back at the last 50 years of history, going back to the early 70s, 55 years of history, and realize, yes, sentiment can get depressed, but it doesn't stay there very long, especially when you're getting this retest of the low like you did in 1982, like you did again in 1993, like you got it in 2011, and like you're getting right now, this retest. I think it's going to resolve higher, and those names that are held underwater like a beach ball are going to be released and rip higher. Again, consumer discretionary, PayPal's, everything related to the consumer, sneakers, VF Corp, Nike, Papa John's, all of that goodness. Index return of selected equal weight cyclicals versus defensive sectors. So this is looking like a short-term bottom. Asset heavy versus asset light index performance. Old school companies that we love have dramatically outperformed in the last 4 or 5 months. Consumer staples now are slightly more expensive than the Mag 7. Emerging markets breaking out for the first time in 20 years. So this is nascent, even if you got to check back. We're going higher, and we're going higher for many years on the emerging markets, ex-US internationals story, so pay attention. M2 growth is growing. Energy sector breaking out to new highs, short interest peaking. So maybe you get a short-term pullback after the war kind of settles out a little bit, or ships start moving energy and energy-related stocks will pull back a little bit, but the multi-year trend is higher. So for market now pricing cut cycle to last into 2027. We agree. Buybacks are at the lowest level since 2020. This is because Mag 7 no longer has the cash flow. CapEx as a percentage of operating cash flow is at 92%. Soon meaning if they don't blink and cut back on CapEx, they will become free cash flow negative for the first time in many years. My expectation is that some of them will start to blink in coming months. They can't buy back as many shares. Emerging market equities relative to global US dollar terms, Hong Kong and Singapore. So again, this is US. This is international stocks beginning their period of outperformance, just as we saw in 2000 to 2007. We're just starting inflecting now. International equities valuation discount to US on forward PE ratio as of January 30th. They're at a 32% discount to US. That will be a reversion to the mean catch-up trade. Annualized, realized, and bottom-up consensus EPS growth estimates for small caps, as you can see, for this year, 59% earnings growth relative to last year was negative 1%. Relative to the NASDAQ at 24%, relative to the S&P at 14%, and next year 29% earnings growth for small caps. That's why we have some small caps in the portfolio, whether it's Dentsply Sirona or others, Canada Goose. How do stocks do after major events? So major events is different than U.S. international strikes, but also, a month later down 0.9%, 6 months later up 3.4%. So we'll see which version it is, but on balance, you don't want to puke in the hole is the name of the game. Relative S&P 500 technology sector relative to total return versus broad market plays. You can see here that tech hasn't been this extended since 2000, and the reversion is starting to the rest of the market outperforming. Small cap ETF inflows now starting to rip higher, just as the index is turning up. Gulf War playbook, sell the news, i.e. buy stocks, but watch oil. So we can see here, Desert Storm, liberation of Kuwait. Start to get some resolution in coming weeks. 78% expect businesses spending to lead economic growth this year, the highest level in our survey history. China-listed Hong Kong ETF still seeing strong inflows. This is just wobbles before the visit in April with Trump and Xi, which I think will resolve higher. I think there's some opportunity there for those who didn't benefit from owning BABA at much lower levels. I think we're getting to the point here where it probably makes sense to own for the next 2 to 3 years. Value outperformed growth by 12 percentage points year to date. Not 2 percentage points, 12 full percentage points year to date. Value has outperformed growth. How you doing, ladies and gentlemen? Tomorrow's newspaper today, those of you who were with us in Q4 when we were pounding the table. So here is the cycle composite for 2026. The implication being kind of what we've been pointing to, meaningful strength into mid to late April, followed by weakness into the election. and then positive resolution November, December. I think that's going to make a lot of sense here, particularly in a midterm year. I think that's the right model to follow, and I think that's exactly what we're going to see and take advantage of every step of the way. Sector ETF total returns as of March 2nd. Energy, materials, industrials, staples have been the biggest outperformers. The worst have been tech, consumer discretionary, and financials. Large cap value relative to growth. You can see the dramatic outperformance started in December, has continued. Staples positioning is still underweight despite the dramatic outperformance. That'll be fits and starts, and they will work higher over time. That's normal in a easing cycle when people start to reach for dividend yields. Inventories to be rebuilt. Here is the TLT, the long bond, smallest speculator long position on record. You always want to take the other side of the speculators and bet with the commercials. And that implies bonds up, yields down in coming months. Wow, we got a lot of data this week. Almost all the growth in U.S. electricity demand by 2030 to come from data centers. That's going to help the Generacs of the world, the Comstock Resources providing the natural gas, etc. And construction. Everyone building those data centers is going to need tools from Stanley Black & Decker, from DeWalt. Stanley owns DeWalt, and so on. Corporate client buybacks falling over. China's rapidly rising electricity supply is key advantage in the AI race. They've got the coal plants. We've been shutting those down. Those will probably get turned on in the next couple of years under this administration. Number of implied Fed rate cuts in 2026 has gone from 2.5 down to 1.75. That's why you're seeing the real jitters of private credit. I think that will resolve in coming weeks as we get a little more stability in Iran. Market declines are likely, not unusual. 10% plus falls happen in more years than not. 20% falls happen once every 4 years. We've had 3 20% plus corrections in the last 6 years. That's why I don't think we're going to get the normal 18.3% correction in a midterm election year. I think we'll get somewhere between 10 or 15% after we rally up to new highs between now and April or May. Everyone gets sucked back in, and then the trap door opens into the election. So we will be prepared for both eventualities. 2026 is the smallest range ever to start a year. Rolling 14-month total returns. That's MSCI World ex-US versus the S&P 500. Biggest outperformance spread since 1993 to 1994. It's just gone parabolic in the last handful of weeks. And you've got typical homeowner stays put for 12 years. That's interesting data. K-Web, you can see here, that's my buddy Brendan's Chinese tech ETF. Most oversold since 2022. So I think we can expect some good things in the next 2 to 3 months. Money market assets swell to record 8.7 trillion. There's powder there for when price starts to move. Opinion will follow a trend at the exact wrong time, as always. What do we got here? Housing affordability continues to tick higher. New car sales. 2026, February was much higher than January, a bit lower than the last 2 years. We'll see what happens in March as rates come down and the tax deductibility on the auto loans kicks in, which will be a big deal. Demand for trucking is rising, highest since 2022. Indicators of demand are firm as shown below. Internet truck stop data suggests that loads available are rising rapidly and currently sit at the highest level since 2022. That's one reason for the acceleration in per mile charges, reflecting a supply-demand imbalance amidst tight trucker supply, driven in part by policy changes and accelerating demand as the economy ramps up. ISM services, PMI. The PMIs were strong this week. Retail cash. Super high level of retail cash net. Notional index to January 2020. So we haven't seen cash this high since the COVID, late 2020. So that could imply we've got a little more runway in upside. Pace of flows. Okay, we've got that. Global manufacturing PMI back into expansion or material expansion above 52 for the first time since 2022. So this was the destock cycle, kept it negative till probably fourth quarter of 2024, and now it's finally turning positive. So a lot of underlying strength despite the short-term volatility because of a couple bombs dropping. Xi eyes consumers to lead new era for Chinese unbalanced economy, so there'll be more stimulus to come. China's record-long Spring Festival holiday sparks travel and offline entertainment boom. Alibaba recruits Google DeepMind contributor to join Qwen AI team, sources say. China commits to ending deflation in 2026 with strongest vow, yes. Yet steering general price levels back into positive territory. Government has targeted and measured steps to curb excessive competition and protect jobs with official measures to boost consumer demand. Economists expect consumer and producer price index to rebound, mostly due to rallying commodity markets and external factors such as President Trump's war with Iran. China signals stability in U.S. ties before Xi-Trump summit. AI CapEx fueling strongest emerging market earnings in 2 decades, Morgan Stanley says. Morgan Stanley raised its year-end target for emerging market gauge and sees December 2026 earnings per share for the gauge at 118, up 33% year-on-year. Emerging markets earnings up 33% year-on-year, followed by 131 in December 2027. Disney launches its adventure cruise ship, a new foothold in Southeast Asia. Intel CFO says server demand still strong amid supply shortage. Buried in Stargate's permits, a generator engine almost no one sells except for Generac. AI trade is alive and living in industrials, small caps, and Asia as the broadening continues. PMI rises in February, marking second month of U.S. manufacturing growth. That's not what you see during a recession. As I said, this will be the year of Main Street, not Wall Street. Main Street will feel good. Wall Street will be a little volatile with a lot of people trapped in the shiny objects from last year. Can't get out. They'll sell the bottom. They'll chase it back up on this rip your face off counter trend rally and then get completely flushed out. When people don't want to buy the dip in software is when it will be the time to buy the dip in software. And that's going to be after this next rally rolls over. Weekly mortgage demand surged 11% higher last week as rates sat near 4-year low. Redfin says more homeowners have a rate above 6% than a rate below 3% for the first time in 5 years. That means the refinancing is going to boom. Anyone in the mortgage business. Why Iran war oil price shock won't stop Trump's Fed pick Warsh from cutting interest rates. He pledged. Warsh's view of inflation doesn't put too much emphasis on factors like oil, so he will likely be confident in cutting rates if oil prices stay up. Morgan Stanley's Wilson says Iran unlikely to dent bullish view. U.S. LNG producers rush to seize on surging gas prices triggered by Iran conflict. Go, Comstock, go. Here are some charts here. Private sector jobs growth turning up. Sign of strength there. CPI versus CPI less shelter rolling over. Owner's equivalent rent rolling over. That was what kept it sticky for a while. Housing prices feed into inflation. Here's U.S. real GDP versus trend. So the 2020 2002 to 2007 trend extrapolated forward was a 3.1% trend. We are so far below trend. So there is a monster economic catch-up trade that will be driven by productivity over the next 4 to 6 years that we are going to take advantage of. And this is something that not enough people are talking about. This is scottgranis.blogspot.com. I think he was a strategist at one of the major asset managers or banks many years ago. And that's that. Okay. Mag 7 are dead. How the hottest trade of the decade fizzled out. So this is kind of cover of Barron's from Andy Serwer, which implies we're due for a massive bounce in the Mag 7. Just like it was the end of the dollar last week, we're getting a counter trend bounce in the US dollar. Besson says global 15% tariff start this week, predicts Trump duties will return to old levels later in this year. Ultra builds super feet in the era of super shoes, gives runners control over how their run feels and where it takes them. That is from VF Corp, Bracken Growth, Daryl, hitting on all cylinders there. Howard Marks says great investors are strong where AI is weakest, and that's in those areas that we talk about every week, assessing management, doing the real work. You know, it's funny. I was on a call with some sophisticated entrepreneurs this morning. They're talking about, oh, where do you get this source of your materials and blah, blah, blah. I was like, yeah, there's this very elite private website. It's called sec.gov, and it has something called EDCAR, where you can pull the public filings and actually read annual reports and quarterly reports and footnotes and 8Ks and proxies and actually understand what's going on in the businesses that you buy. But no one wants that. They want a simple, easy multiple, which means nothing, or backward-looking data versus extrapolating the normalized earnings power of the business and whether or not the price in the public markets accurately reflects that. Article of the week, the enabler stock market and sentiment results. So let's update on Stanley Black & Decker. Almost doubled off the lows. Now it's pulling back in the short term. It's one of our favorite pick and shovel ways to play the long-awaited housing market recovery. The company is now turning the page on a multi-year restructuring journey that began in mid-2022 after getting caught off sides in the destock restock cycle, leaving the company with a bloated balance sheet amid rate-driven housing slowdown. The turnaround plan centered on a $2 billion cost reduction program built on supply chain improvements, inventory reductions, and right-sizing the corporate structure, all aimed at restructuring gross margins that had been clobbered to just 19.5% in Q4 fiscal year 2022, back toward their historical 35% plus range. At the same time, Stanley Black & Decker found itself with an over-leveraged balance sheet, with net leverage reaching 5.9 times at the end of fiscal year 2023, following an ill-timed acquisition just ahead of the slowdown. The good news is that the latest Q4 earnings report largely closes the chapter on this restructuring effort. Management squeezed out another $120 million of cost savings out of the business in Q4, bringing cumulative pre-tax run rate cost savings to $2.1 billion, ahead of the original $2 billion target and representing north of $13 per share in savings. Those savings have helped gross margins rebound from the depressed levels to 33.3% in Q4, up 210 basis points year on year, knocking the door of 35% target management expects to reach by the end of fiscal year 26. On the balance sheet, net leverage has improved by 2.5 turns over the past 2 years to 3.4 times, with debt reduced by $1.3 billion and adjusted EBITDA increasing by $500 million, or up 44% over the same period. The final piece of the balance sheet cleanup came with the announcement of the pending sale of CAM, Consolidated Aerospace Manufacturing Business, to Howmet Aerospace in an all-cash transaction valued at $1.8 billion, or 18 times EBITDA, sold to you, expected to close in the first half of 26, with net proceeds of $1.525 to $1.6 billion earmarked for debt repayment. The transaction supports another 1 to 1.5 turns of deleveraging and puts Stanley Black & Decker well on track to reach 2 times net leverage by year end. With the heavy lifting now largely complete, Stanley Black & Decker emerges as a leaner, stronger business, with the focus shifting back to its core brands and a return to organic growth. On that front, Management expects low single-digit organic revenue growth in fiscal year 26, marking the first full year of positive organic growth since fiscal year 2021. Growth will be led by DeWalt, the $7 billion plus pro-focused franchise that once again defied gravity in fiscal year 25 with low single-digit growth, along with a long-awaited sales inflection in the do-it-yourself-oriented Craftsman and Stanley brands, driven by some of their largest new product launches in recent history. What's even more exciting is that this return to growth is expected in a market that remains flat and under pressure throughout the year. In other words, when the cycle finally turns and the beach ball of pent-up demand breaks free thanks to all the secular drivers we often discuss, 4 million unit housing shortage, 70 million plus millennials in prime family formation years, lower rates, significantly aged housing stock greater than 40 years old, Stanley Black & Decker will find itself better positioned than ever before to capitalize. And while we wait, we sit back and are paid handsomely with a 4% and growing dividend yield. The payout the company has maintained for 149 consecutive years with 58 straight years of increases. All the signs we want to see with names like SWK are now in place. Growth is inflected, margins are expanding, and free cash flow is accelerating. $800 million expected in fiscal year, up 16% year on year. With the balance sheet cleaned up, share repurchases are back on the table as well, with shares still down more than 60% from their prior highs. We continue to view this recovery as just getting started, as the world's #1 leader in tools since 1843 reminds the market what it's all about. Here's the Q4 earnings breakdown. We've highlighted and underlined all the important things you need to know. You go to hedgefundtips.com. Click on terms while you're there. This is all opinion, not advice. Consult your financial advisor before doing anything, or get one, one or the other. You can find this article in categories under commentary and every article we've put out in the last 6 or 7 years. So you can scroll down there, go through the important stuff and the 10 key points from the earnings. Moving on, as well as the earnings call transcript. So a lot of work goes into these every single week, and we want you to take advantage, all for the right price of $0. Generac update. Generac, the Kleenex of generators, that was once a sleepy name, has quietly turned into a massive winner for us as the market begins to recognize the company has become a key pick and shovel beneficiary of the AI data center build out. Even better, it offers that exposure at a reasonable valuation, a textbook example of what we mean when we say AI beneficiaries, not AI cost centers. Naturally, there's plenty of excitement around this name right now as the company rides the newfound wave of what management has made clear is the biggest needle-moving opportunity in company history. This is all centered on the company's new large megawatt generators, where backlog has already swelled to 400 million for these school bus size units priced at $1.5 to $2 million each. Generac is stepping into a market facing a major supply crunch, with the company uniquely positioned to offer lead times shorter than the competition through 26 and likely well into 2027. While initial success has been driven by co-locators and developers, which make up nearly the entirety of the current backlog, the real upside potential lies in landing a hyperscaler. Generac is currently in pilot phase with 2 separate hyperscalers, which management expects to wrap up by the end of Q1 and translate into purchase orders flowing into the backlog beginning in Q2. Now, here are the most important lines from the earnings call. Quote, to answer the last part of your question about our contemplation of doubling the C&I business over the next 3 to 5 years, if we had to be very honest, that was really landing one hyperscaler. If we landed one hyperscaler, that would get us to a point of doubling, and there's an opportunity to go higher than that, of course. In plain English, Generac is in active talks with 2 hyperscalers and is highly confident with both. Landing just one leads to a doubling of the $1.5 billion C&I business. While the market gets excited about the data center opportunity, it's worth stepping back and remembering how this investment started. When we originally underwrote Generac, it had nothing to do, and by the way, at less than half the price, below 100, it had nothing to do with the data centers. The thesis was simple: the industry leader temporarily beaten down by a destock restock cycle that the market had treated as a permanent impairment. This thesis remains fully intact today and has only gotten more attractive. Generac continues to dominate the high margin home standby market with 75% share and a long runway still ahead with household penetration at just 6.75% and every 1% uptick representing a $4.5 billion opportunity. The AI data center tailwind was never part of the original investment thesis. We couldn't have predicted it, but are more than happy to take the free flyer. And that is exactly what it is for us, a free flyer. In many ways, this setup reminds us of our Intel investment. When we originally underwrote Intel, the thesis was based on the legacy CPU and PC business alone being worth $45 to $50 a share, offering a double with the domestic a double from our cost basis, with the domestic foundry bet being whipped cream and cherries on top. The situation with Generac rhymes. The legacy residential and traditional C&I business was undervalued following a once-in-a-generation demand pull forward and subsequent destocking cycle. And now we find ourselves with the added bonus of a free flyer on the data center end market. But unlike the domestic foundry effort at Intel, this free flyer comes with even fewer question marks and the writing arguably already on the wall. It's only a matter of time before headlines start coming out of hyperscalers signing deals with both Generac and Intel. At the end of the day, this investment is a textbook example of our core investment philosophy from the master himself, Warren Buffett. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock price to be misappraised. That is our guiding philosophy at greathillcapital.com. When you identify situations like that and stay the course, good things tend to happen. The next major catalyst for Generac is the March 25th Investor Day, where management is expected to go into detail on the scale of the opportunity ahead and perhaps provide the stage for a big announcement. So here are the key things from the earnings call, the deck, the growth, the opportunities, and the 10 key points from the earnings call, as well as the transcript with the most important things underlined. So that's that. As we look into market sentiment, it's now at fear. Is it fully flushed? We'll find out in coming days. Doesn't matter. But it looks like we're retesting the previous day lows. We probably overshoot it a little bit just to scare people out, and then see if we get a taco announcement of good things happening in Iran. Communication service earnings estimates, top 30 weights in the last 60 days revised up 22 basis points. Tech earnings revised cumulative 26 earning powers of the top 36 stocks in the tech ETF were revised up by 12.07% in the last 60 days. And I think this will probably be the fodder for the big counter trend rally here in coming weeks. So pay attention to that. Here are the manufacturing numbers I was talking about. ISM manufacturing February was greater than expected at 52.4. Global manufacturing 51.6, greater than expected 51.2. So a lot of good economic data coming out. Earnings growth was 14.2% with 75% reported. Expectations were 8.9%, so much better than expected. So now let's get on to our amazing Ask Me Anything questions from our incredible Hedge Fund Tips with Tom Hayes audience. First one comes from Sarah Spencer, curious on why Cooper Standard has given back its gains from a seemingly good earnings report and refinancing. Was that because of the terms in the 9.25%? No, they have to complete the refinancing, so there are jitters that they won't complete it because of the private credit fears. All the private credit fears and risk are around data centers right now. This will get done in our view, and this is a short-term overshoot on the private credit fears. Richard, CoStar stock down, but a lot on investments, and now with that behind them, profitability should strongly increase over the next 2 years. What are your thoughts? Okay, Rick, let's take a look. I think this is in the software category. Okay. So this has dropped 50%. And let's take a look. Share count continues to rise, though. Free cash flow is negative, just turning positive. Margins are declining. Multiple seems a little bit high. What are they? Let's take a look at their business. I'm willing to bet. Provides information analytics on online marketplace, real estate and related business. Because our inventory, hospitality, housing, blah, 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 blah. So software. Yeah, I mean, the balance sheet's fine. Cash flow looks okay. But it's in the software sector. So for me, this is not the type of business we would ever own. Free cash flow just turned positive, but the balance sheet, I think, is really healthy, like most software companies. Yeah, they got $1.5 billion of cash, $1 billion of debt, and the income statement. Let's take a quick look here. Yeah, continues to grow. Let's take a look at the shares outstanding. A little rich on the stock-based comp here, a little piggy here. They've doubled in the last year. Don't like that. So look, this is not a business that we would ever own. I think that you're probably going to be okay. You're certainly going to get the short-term bounce with all the software stocks that have been beaten to death. You just better be damn sure this can't be disintermediated by Claude or something else, and I don't have that certainty. So for us, it's a pass, but I think it's going to work for you. Patrick F, love the pod, new listener from Ireland. Welcome. How you would think about Moderna right now? And would you sell if holding the stock? Well, I would never be holding the stock. We don't do individual biotech names because we can't predict how the phase 1 and 2 trials are going to happen. I think, we don't make bets on promising neo-antigen immunotherapy phase 3 readouts. That's not what we do here. We bet on sure things. These are speculative things, so I don't have a good answer for you, but welcome, and you'll learn more as you listen each week. York Bourgeois, hope your week has been well. Wondering what you think is the highest and best use of your time right now. I think the best bang spend right now on research, client calls, management, family, interested in what you say. York, I don't know how the answer to this question helps you, but I think the highest and best use of my time is the same as it's always been, finding the highest and best use of the capital for clients and focusing on the returns for clients. And if you deliver for your clients over time, everything else takes care of itself. All the other stuff you can hire people to do. But what you can't do is expect to outperform by committee. Outperformance is from a unique framework and a rigor around that framework, not to be sidetracked and get caught up by shiny objects, which 99% of the population does and will always get caught up in because it's just human nature. We're taught to follow the herd to survive, and to stand aside from the herd is uncomfortable in the short term and very pleasurable in the long term if the framework is right. So no change in the highest ROIC on my time. I do what I enjoy doing, and what I enjoy doing is skipping to work every day on a treasure hunt to find good businesses at great prices, and in public markets, they're always available, and it's just a blessing to be able to do this. So good question and answer. I don't know if that answer helps anyone make money other than my clients, so that's probably good enough. Sam G. Wanted to get your thoughts on UWM Holdings. Yeah, UWMC. I think this is the mortgage business. I could be wrong. UWMC. Negative free cash flow, keep growing the share count, huge debt. I'm not sure what there is to like about this. What is it? Yeah, originating servicing a residential mortgage. I would go for Rocket Mortgage over this. You know, the management of this one, Rocket Companies is a better way to play it. I'm not thrilled with the management of UWMC, but I understand why it's interesting, but I don't think they're interested in their partners making money as much as they're interested in making money for themselves. So for that, I'm a pass. All right, so Derek Stefanik, thank you for all your support. He's gotten people listening. He wants me to sponsor a race car. Probably not what we do in terms of, we don't really do much advertising. We just deliver returns and people call us. But thank you so much for that support. I had another guy wanted me to sponsor his golf. It's not what we do here, but thank you for the opportunities. This is Mercado Libre. This is a South American Amazon. I don't think the margin of safety is big enough here for Matt, but you're probably going to get a bounce with everything else in the coming couple of months. I'd relook at this towards later in the year. If it gets down to 1,000, I'd be very interested. I don't know if it ever will. But all the financials are good except for the margins continue to decline. Revenues are good. Free cash flow is good. What are you paying for it? It fits the emerging markets theme. There's definitely a lot to like. I just like to buy things that are down a lot more than 30%. At 50%, I start to look. At 70%, I start to get a little bit excited. At 80%, I start to lick my lips, and then I just see if it's going to have a solvency issue. And if we can get through the balance sheet, then we start to look at cash flow. Then we start to look at management's respect for equity. Then we start to understand the business and discern the moat. But on this one, I would just like it to look at this at it. Point is, it's a good business. It's just, I like to get in when they're completely decimated, and this thing is not decimated. And sometimes great businesses never get decimated. So for me, it's a pass. Send it back in at, $12.50 instead of $17.50, and we'll take a better look. But you definitely picked a great business there, Matt. It's just not a big enough dislocation for us to get excited about owning it, which again doesn't mean it won't go up because it's a great business, maybe at a good price. We want a good business at a great price. Jack S, love the pod, weekly media appearances. He wants to know what cars I drive. Well, one, it's not a car. We have cars, but we're not going to talk about material things on this call. We're going to talk about making money from investments. John Clark, thank you for sharing your thoughts every week. What do you think about Penn stock as a possible turnaround? You'd really have to have a new CEO in place. They made that really weird deal with Barstool years ago and lost money. Still cash flow negative. I don't want to be involved in this thing. They blew up the share count. I mean, they're buying it in. Maybe it's a turnaround. I just don't love that business. If I'm going to be in the casino business, it's got to be the highest quality, and they're the opposite of that. Okay, that's the golf sponsorship. Thank you for your support. We don't do that. Gaspard BDT. Yeah, the derivatives are reserved for my client's benefit, so we're not giving out the exact expression for those. Buy the stock, get your doubles and triples. Jimmy Jones, thoughts on Baba. Baba is just a waiting play. We got to get earnings and see the data, and then we got to get the Xi Trump meeting in the rearview mirror, and then we'll revisit it. We still own every share of stock. We obviously made 7x on the spreads last year, made an enormous amount of money off of that, but we're holding this stock for the long term. A lot of outs, a lot of good things happening there. Young Sung. Actually, we bought a little bit this week, to be honest with you. So that tells you what you need to know. Thank you so much for your wisdom every week. Learn so much for watching your shows. Gartner. Okay, so this is a software stock that is going to bounce with the software bounce. I mean, this one's really smashed. Yeah, I think you're right on a financial basis. I just don't have a way of distinguishing if that moat is impenetrable because of the type of services that they provide. So for that reason, I'm not going to participate, but I do think it's going to work on a trading basis. You're going to get a violent counter trend rally here. And whether that holds or not will be determined by what you hear from management in coming quarters on the impact of AI. My guess is they're going to use AI to benefit from it. So on that basis, I mean, the stock is down 75%. If I had to buy a software stock, I'd probably be looking at this one pretty seriously, but I don't. So for me, it's a pass. So enjoy the next 2 months of a rally in this one. We'll see you in the fall, hopefully at lower prices. Chase Brushaber. Okay, I don't know if there's a question here. Let's see. You've truly changed my life and investing philosophy. I started my investments during COVID, where I read 10 books prior to getting started with paper trading. Since then, following along with your VideoCast, I started with 60,000. My account is now 300,000 and still growing. Thank you for all you do and continue the great work within the markets. Look forward to future growth. Avid golfer. Oh, okay. So that was just a thank you. Thank you very much, Chase. And yeah, if I'm ever in Mississippi, in Pascagoula, Mississippi, I would love to play golf with you. And thank you for sharing that good news. Nintendo. Will G. Nintendo. So this is almost cut in half in the last few months. So free cash flow has been trending down. What are revenues doing? Trending down. Share count's also trending down. So it's got a healthy balance sheet with declining sales and declining cash flow. So you're betting on some catalyst to change that. And while you're betting, you're paying 25 times earnings, 21 times enterprise value to EBITDA, 3 times sales. Yeah, this is not one that we would be involved in, but I could definitely see from a trading point of view this thing bouncing. We'd have to study the business and understand the catalyst, but this comes into the realm of predicting the future and versus kind of like durable, long-term, consistent business. This is not the type of business that we would be in based on our framework. But there are many people that can make a lot of money predicting the future of what these businesses will do and intend to do with future games and everything else. And a lot of money can be made in this sector. It's just outside of our framework. But like if I look at it on a technical basis, yeah, I could see it definitely bottoming and rallying from here. When I look at it on a fundamental basis and the trends in the short term without knowing what management is promising to do to turn it around, there are higher and better uses from our standpoint, but our framework is different than others. So I guess the short answer is agnostic. So they've increased focus on movies and parks. Yeah, these are all prospective. They're like expectations of what might work, and they could very well work, but we don't want to take those bets for the framework that we use. We just basically look for a business that has steady cash flows over time, steady revenues, been around for a long time, and price goes like that around the cash flows and the revenues, and we try to buy it when it's here, and it goes lower, we buy more, and then it rallies, and we think we sell the top, and it goes a little higher like Albemarle, and then it rolls back over. So for us, that's easier. We don't have to be in the prediction business, but those who are, money can be made in a company like this, especially when you have cash, you have a lot of optionality. But for us, it's a pass. NVCR, Novacure. Okay, so here's another one. I think this is a biotech. Don't get me wrong, guys. I mean, free cash flow negative, shares keep growing. This looks like a biotech. Oncology company, blah, 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 blah. Treatment of tumor cells. Yeah, you're just betting on something happening with these drugs while they burn cash, and that's not what we do. So pass for that. Welcome to the podcast, by the way. Lucas Trendgrove, ADV, Advantage Solutions. ADV. Wow, what the hell do these guys do? All right, so cash flows collapsed. Revenues are down. They issued a ton of shares during COVID when their stock was up. They went from 45 million shares to $300 million shares. Outsource sales, marketing, merchandising, sampling, retailer support to consumer packaged goods. In-store, blah, blah, blah. In-store and digital sampling programs. Yeah, this is not my cup of tea. Let's take a look at the balance sheet real quick. $140 million of cash, $1.6 billion of debt, $240 million in cash. What's happening to the cash flow? Down but not out. Revenue's pretty flat to down. Shares outstanding. Yeah, this is not the type of business we're interested in. My sense is this management has a history of diluting their owners, and I wouldn't preclude them from doing it again. Bellring, BRBR. That's from Santa Cruz. I'm sure that's the name. Welcome, Mr. Cruz. This is a broken momentum stock, and it's going to take probably many years if they survive to build a base. So I think you're too early if there's something here, and nothing to worry about if there's not. What is Bellring? Is this just another various nutrition products, ready to drink protein shakes, protein powers, Premier Protein, blah, blah, blah. It's a very competitive business. Yeah, I should have my buddy Michael C. chime in on this. You know, this stuff runs in favor and out of favor. Premier Protein. Yeah, this is wild. I think the first thing you want to figure out is, why is the stock down so much? Was it some type of scare about the... They got $64 million of cash and $1.2 billion of debt. So there's probably some worries about their ability to refinance and whether they'll have to issue debt. But they had a run here for sure. For like 4 years, they must have had a super hot product that's now a little bit out of favor. This is all guessing stuff. This is not really for me, but just figure out what was the catalyst for them to collapse, and what is management telling you is the catalyst to recover, and whether that seems realistic. But at this level, I mean, something like this is not going to bounce back up. It's going to probably take 2 or 3 years to find a new shareholder base and get support and rebuild trust, because the stock doesn't fall from 80 down to 15 if they didn't screw something up royally. So you're just early. If there's something there, you're early, so you're going to have plenty of time to do the research. There's no rush to buy. Can you look at Mountain Vale Resorts? I just spent some money with them up in Whistler. These are not the type of stocks. We covered this one a couple weeks ago. I think it is kind of attractive here, but we don't do these type of businesses. This type of company really shouldn't be public. It should be private, and they should just dividend out all the beautiful cash that they make every year. So I think if you're going to buy it, you're probably at a good level to buy it. This is not something we want to be involved in. Sebastian P. Yeah, that's on that. All right. Eric Haney. Roblox below 60. Not interested in that business. Daniel Murphy. Siri, that's a value trap. It's been forever. CK Patel. Bath and Body Works. Not for us. BBWI. Looks like it's turning a little bit from a trading perspective. I don't like this type of business. They're competing indirectly with the Ultas and the Sephoras. They kind of missed that whole beauty craze. But if you want bath sprays and the like, they're probably okay. I don't like this. It's a retailer. And Daryl M. Just ordering some merch. IOSP. Immunospec. All right, so prices followed cash flow. Revenues have been flat since 2022. Balance sheet looks okay. They're taking the share count down. What do? Manufactured blends. Specialty chemicals, yeah. All these chemical stocks have been left for dead. I'd probably be more inclined to go up the food chain a little bit. To like a Dow. It's already started to recover. FMC, we've talked a lot. That's a little riskier. IOSP. Let's take a look at the financials here. Okay. Cash flow is okay. Revenues have been hit like all the chemical stocks. This is a cyclical. I mean, it's share count's okay. Stock-based comp is not egregious. Return on capital, it's okay. Oh, multiples. It's okay. I mean, this is a okay business at an okay price. I would like a little bit more margin of safety, but I think it probably works higher from here. And but I can't. It's not dislocated enough where I'm certainly not going to get a triple in 3 years. I'd be really lucky and probably unlikely to get a double in 3 years. So for that reason, it's not a good enough use of our capital, even though it's probably going to go higher. And I think your analysis is good. Sell next. This is another biotech. I think I'm going to jump out the third story window and sprain my ankle. CLNX. It's a telecom. All right, so they're just turning cash flow positive. Debt's at 20.4 billion. Yeah, these country telcos, what is this? France, Italy, UK, they just tend to be value traps. For that reason, I'm going to pass. Alejandro Bustamante, Restoration Hardware. He did a DCF. You know, it's funny. Charlie was talking with Charlie Munger was talking about Warren, and he says, you know, Warren always talks about intrinsic value being a present value of future cash flows. I don't think I've ever seen him do a DCF calculation in 40 years. Why? Because he buys businesses that have such a large margin of safety when he buys them that he can do the math on the back of a napkin. I've never liked Restoration Hardware. As a matter of fact, this was one of the first stocks that I had to talk about when I started doing TV. On my first hit, I had to talk about Occidental Petroleum, which was, a walk in the park for me, and Restoration Hardware, which was the last thing in a million years that I wanted to do, because it's always traded at a super high multiple. This is not for me. I'm going to pass. I don't like that type of business. Okay. Joe W. Grab. This is a delivery stock. I'm also going to jump out the third story window and sprain my ankle. Let's see. All right, looks like it's inflecting here. Problem is you got this can't be real. 62 million shares to now 3.7 billion. These people should rot in hell for doing that to their partners. All right. Let's see. I see the turnaround, but it just seems like if they get any runway at all, they're going to screw their owners. So let's see. Super apps, driver for merchant partners. This is the type of stuff that'll be first to get disintermediated by AI, and people can just do it person to person with no friction. But it won't happen overnight. For the I like. Here's what I like about your idea. I like that it's ex-US. I like that it's beaten down. I don't like that they don't respect their owners. Let's take a look. And I don't like the business in general. Reminds me of Meituan, which was a disaster. Had a family office. Anyway, it's funny. Their analysts are like, why do you own Baba at 60 when you could buy Meituan? Meituan is the future. I'm like, it's a fucking delivery service that's going to get completely commoditized and destroyed by Alibaba once they figure it out. And that's exactly what happened. So this next week, on Hedge Fund Tips with Tom Hayes. Tom is going to tell you how he really feels about things. All right, so let's take a look at cash flow. Still negative, but turning up. It's never given you a return on invested capital. Revenues are still growing. Share count is going bananas from 181 million to 4.2 billion. And look at the management, stock-based compensation is through the roof. These people, as we say in New Jersey, are scumbags. Tommy Sirios. Weibo, the Chinese Twitter. The only stock we're willing to own in China is Baba. We buy the highest quality assets in the most dislocated sectors. This is a... Oh, let's take a look. See, while Alibaba's been bringing their share count down in all the weakness, these guys have been increasing their share count. So right now, that alone tells me they have their head on backwards, and they've had the free cash flow to buy in stock, and they haven't done it. So yeah, could it bounce from here? Yes, but it's not the right mindset. Tom Johns. He's asking about dividend strategies. Just wait. As rates are lowered, the dividend stocks are going to be clamored for. Hey, Tom, thoughts on Papa John's? We're going to do that in coming weeks. We're fine. We bought some this week. Alejandro Bustamante. Red Robin Gourmet Burger. I think this is a crowded space. How are you going to compete with the McDonald's CEO taking his micro dose of the Big Mac this week? I mean, talk about high conviction leadership. All right, Red Robin. My guess is their balance sheet is in trouble. Free cash flow is still negative. Revenues have been flat for 15 years. I don't think so. Let's see. Balance sheet. They got 20 million of cash and $500 million of debt. Modestly free cash flow positive. And zero signs of growth. And share count going up. This is, I mean, you would need a miracle. So unless they've hired an incredible CEO like you have at Papa John's who turned around Wendy's, I would pass. John M. Thesis on the turnaround is on Hedge Fund Tips with Tom Hayes site. We'll do it again this quarter. And what's next? All right, so that's that. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.